Earnings calls are super important for company leaders to talk to the public. As pro investors, we gotta look past the surface to figure out what the company's really thinking. Even though big companies like Google might dodge questions like their White House press secretaries, if we can spot the little changes most people miss, we can get ahead of the consensus and make money from having a different perspective. So, let's do this, and I'll base my interpretation on the full text of the earnings call. The total revenue increased by only 3%, but the net profit fell by 8%, which includes 1. The revenue of cloud computing is growing, but its market share is still far behind Amazon and Microsoft. 2. The search business has shown a recovery, which is related to the overall economic activity, but it is still possible to be undercut by Microsoft Bing's advertising business within 2023. 3. YouTube is on the decline, and it's worth noting that YouTube has been Google's most prominent B2C business in recent years, but now it is significantly impacted by TikTok. This also explains why Google's stock price initially rose and then fell after the earnings report was released, and the cloud computing profit is not normal either. I will analyze this further in the following content. We need to know that the CEO sets the tone at the opening, giving investors and the company confidence. Of course, they cannot lie, so they start with good news and then discuss concerns, following a standard procedure. From an emotional perspective, the positive evaluations from high to low are: first, strong momentum in the cloud business; second, good performance in the search business; third, AI product updates launched. All others are lackluster. Cloud business has strong momentum, growing by 28.5%. Microsoft grew by 27%, Amazon grew by 16%, but last year it grew by 44%. The growth rate is slowing, but Amazon and Microsoft's market share is 3.5 and 2 times that of Google. The growth of the cloud business has become the only source of confidence for the CEO. Last quarter, they even mentioned YouTube, which seems to be in decline this quarter. AI developments, mentioning the 3 areas from last quarter: 1. Continue to develop the most advanced LLM and make significant improvements to products. 2. Empower developers, creators, and partners with tools. They launched Bard, which caused the stock price to plummet by 10%. On the day of GPT-4's release, they also released the Palm API and Maker Suite for developers, which went unnoticed because these products not only lacked decent demos, but most people couldn't even find the registration portal. Even if they registered, they would be on a long waiting list. What's even more ridiculous is that Bard is only open to users in the United States and the United Kingdom. Do they think their users are idiots who must use their product? This is like someone building a car but never letting you test it on the road. They still call it the most advanced something and a significant improvement in products. Google is trapped in its own bureaucratic system. 3. Enable organizations of all sizes to benefit from AI. They talked about how many organizations are using Google Cloud and Workspace products. This section is very hollow, filled with adjectives and vague nouns. When it came to Performance Max, Pichai handed it over to CBO Philip. Pichai talked about the consolidation of the Brain team and DeepMind into one department, calling it a focus and integration. However, we know that for a trillion-dollar company, organizational restructuring that only involves overlapping and splitting up departments is often just a CEO's way of finding a bigger scapegoat. We can learn from some comments made by Google insiders that this merger was actually a necessary move during a crisis. Following the Code Red alert, management had to address the issue of both ivory towers, focusing only on research and not caring about the business side. DeepMind's CEO insisted that the name couldn't disappear, so Brain had to go. However, a strange arrangement was made. Brain's leader would continue to report to Pichai, allowing him to act independently under the new DeepMind CEO. I asked ChatGPT who would be in a more dangerous position in this seemingly politically correct arrangement, and the answer was Hasabi's. He's under high expectations in the industry, and although it seems like he got everything he wanted, he's likely to face constraints everywhere. Bureaucracy has permeated every capillary of Google. After the extremely dull and disappointing performance discussion in the previous sections, Pichai needed some confidence. He mentioned that 60% of the world's largest 1,000 companies are Google Cloud customers, but did not answer why their market share is only 10%. He used a very unprofessional and inaccurate expression. Many leading startups and millions of small and medium enterprises use Google Cloud. Who knows how much many is? Do Amazon and Microsoft say a lot and a whole lot? Google's TPU, along with NVIDIA's GPU, may provide physical support for the AI world. Unfortunately, Pichai did not go into detail. Since the release of TPU v4, hardware achievements seem to have been completely overshadowed by the achievements of OpenAI software. Yes, what's important is the output. So BERT is for encoding, and GPT is for decoding. TPU is a long-term advantage for Google in a space where only giants can survive. Its main competitor has always been NVIDIA's GPU. According to Google's official statement, the performance of TPU v4 is 1.7 times that of the contemporaneous GPU A100. However, in 2023, NVIDIA released the H100, which has 6 times the performance of the A100, so it's still uncertain who will come out on top. Google has a deep accumulation of expertise in chip, architecture, model, and application layers, but it faces extremely powerful competitors in each field. TPU competes with NVIDIA's GPU, deep learning architecture layers, such as TensorFlow or JAX, compete with Meta's PyTorch, and Bard models compete with OpenAI. Each level seems very challenging. Competing in individual aspects alone does not guarantee absolute leadership, and integrating these single capabilities for overall competition becomes even more difficult. Some unnecessary information was discussed, using phrases like, "we're doing," instead of, "here are the numbers we achieved." Of course, the announcement of Susan's departure was made. In some ways, Susan's departure was a graceful exit. However, with the significant increase in subscription fees, YouTube has undoubtedly overdrafted on some user value. We can glean from YouTube's frenzied promotion of Shorts that it is being impacted by TikTok. It seems that only the government can deal with TikTok, just like how the Chinese government forced Google out of China. Who would have thought that Google's lifeline would fall to relying on the US government? Since Chrome's glorious achievements to date, Pichai hasn't had a second outstanding product to endorse him, yet he was promoted to the position of CEO. From various sources, it's said that Pichai isn't actually happy with this role. On one hand, there's the shadow of Google's founders, and on the other hand, he doesn't have much experience in managing such an organization, competing with the world's top-tier companies, facing criticism from governments around the world, and managing some of the most disobedient employees in the world is truly not an easy task. In summary, Pichai is truly a professional manager, not seeking to be brilliant, but rather to avoid making mistakes. In the various public relations events that Google has faced, he has been so steady. From his speech, our subjective perception is that 1. AI is still in a very immature and unshowable stage, but Google has high hopes for it. 2. The cloud business can stop burning money through revenue growth and cost control, but the growth rate has also slowed down. 3. YouTube has a strong element of uncertainty with a new business leader, and it is unclear whether it can withstand TikTok's exit from the US. There is really too little useful information. 1. This shows that users are generally averse to ads in the long run. As for the business model, due to the convenience of payments, the subscription model has become the main means of increasing ARPU. 2. Whether it's the smart bidding model, auto generation for startups, or Performance Max, they all aim to improve productivity and conversion rates. Travel recovery-related growth is particularly mentioned, which is an area worth paying close attention to given Google's revenue scale. I think it indirectly benefits stocks like Airbnb, Booking, Ctrip, airlines, and Uber. Keep an eye on companies that haven't reported their earnings yet. The focus here is on Performance Max's support for retailers with both online and offline presence. Google's performance in e-commerce has always been weaker than Facebook's, and there's still a lot of room for improvement. Just looking at Google Shopping's performance, most products are actually still hard to find. This is not just a crawling issue, but mainly due to businesses' active engagement and operation within the system. We can follow Google Shopping's head, Jeff Harrell, to see if there's a turning point. There isn't much information about him, but from what I saw on LinkedIn, Jeff likes to congratulate former colleagues who left Google for new jobs. It seems he cares about pleasing others, and people's feedback about him is generally friendly. Judging from the shopping team's blog, they have not been as busy in 2023 as they were in the previous 2 or 3 years. They surprisingly had no activity updates from March to April. I believe that not only their team, but the entire Google team has fallen into a relatively passive mindset. In the minds of American consumers, Walmart and TikTok have seen astonishing growth when it comes to the starting point for shopping, while Amazon and Google have experienced significant declines. YouTube, on the other hand, has seen modest growth. From Google's battle against OpenAI, it's easy to see that Google is a company with a dispersed organizational capacity. All their products, business, and technology strategies seem to be a step behind their competitors. This is not only due to the company's size and concern about making mistakes, but it also reflects that the sense of crisis has not truly been conveyed to every capillary of the company's upper management. When traditional companies like Walmart can achieve growth in shopping, where does Google CBO's confidence come from, thinking that the battle has not yet begun? 1. Revenue can be built up by various costs and expenses, but the result of this cost-no-object approach is a significant decline in operating income, indicating that spending efficiency is decreasing. 2. Starting from Q1, Google changed the depreciation of cloud computing servers and related hardware from 4 years to 5 or 6 years, reducing a total of $988 million in depreciation expenses in a single quarter. 3. What's odd in the middle is that the cost recognition method was adjusted at the same time, with Google service being recognized to the C-end and some shared R&D costs being shed from the B-end business costs. Logically speaking, Google wouldn't need to pursue cloud computing profitability during its growth phase if it wasn't eager to explain itself to the stock market. Institutional investors who come to their senses should not expect the same level of growth next quarter. 4. For a behemoth with hundreds of billions of dollars in revenue, very clear plans are needed to achieve visible cost control in financial statements. 5. This was not mentioned or explained in the earnings conference transcript. For the company, this approach is undoubtedly effective if it only needs to combat the market undervaluation caused by COVID and inflation. But today, Google is facing an underlying attack from another trillion-dollar giant that not only targets Google's C-end core business search, but also covers its B-end cloud business, and that's OpenAI. As shareholders, we'd rather see Google spend money on more meaningful products, accelerate Bard's iteration, instead of merely inviting users from the United States and the United Kingdom to wait in line for Bard after OpenAI has already launched at least 2 fatal attacks. Convey confidence in the following aspects. 1. strong financial performance in Q1 2023. 2. Developing large language models to provide tools for developers and partners and enable organizations of all sizes to benefit from AI advancements. 3. Enhancing the search experience and making it more helpful by combining generative AI. 4. The fundamental role of AI in advertising, with products like Performance Max offering untapped conversion opportunities for advertisers. 5. Building strong relationships with large enterprises in the cloud computing sector. 6. Using AI to help people, businesses, and society reach their full potential. However, they also expressed these concerns. 1. The possible slowdown in growth for Google Cloud after a brief period of profitability. 2. Optimizing methods to help clients achieve their goals amidst economic uncertainty. 3. A decline in search revenue growth in financial, media, and entertainment verticals. 4. Integrating AI teams to gather talent and computing resources to build capable and responsible models. 1. In the macroeconomic environment, Google's capital utilization efficiency has not improved, and its net profit may continue to decline. 2. As Microsoft's search share increases, corresponding revenue will also increase, impacting Google's mere 3% revenue growth. 3. Cloud business driven by small and medium-sized enterprises has already begun to significantly slow down, and profits may turn from gains to losses. 4. Shorts performance is not even as good as Reels. In the AI environment, the volume of video transmissions is no longer enough to judge a platform's value. Audience watch rate and participation rate are the key indicators, and Shorts need strong leadership in this area. 5. The explosive growth of e-commerce has brought limited benefits to Google. On the contrary, people are more willing to advertise on content browsing sites like Instagram and Facebook, while shopping's competitiveness has not been unleashed. 6. Progress in AI is extremely slow and conservative, although Google's strength in this area is not lacking. 7. Most importantly, the management no longer has the same sharpness as Tesla, Microsoft, Nvidia, or even Meta. The company, under the bureaucratic habits and the fear of making mistakes in management, has already choked its own throat. It is indisputable that among TikTok, Reels, and Shorts, Shorts performance is the worst. Whether it's user engagement, comment count, or watch rate, it is far behind the first place and even has a gap of 5 times compared to the second place. The core traffic of Shorts also comes from the strong push on YouTube's homepage, which is a double-edged sword and may eventually harm the experience of long video users. If a platform reaches 50 billion daily plays and still cannot be self-sufficient, it can only mean one thing. It is just a giant infant. About 3. CEO Pichai believes that users want choices, and Google feels comfortable because it can continue to innovate as usual. However, the reality is that its search market share has already begun to be taken away by Microsoft, and this will continue to happen because Microsoft will not let you feel comfortable. They have been uncomfortable for 20 years. About 4. CFO Ruth seems confident that Google will make a difference in innovative cost-cutting through AI technology, but from what we see, Google has laid off 12,000 people this quarter. If we go back to the 2022 Q1 earnings call, we will see CEO Pichai say, "To help support our own flexible work plans this year, we plan to invest approximately $9.5 billion in our U.S. offices and data centers, creating at least 12,000 new Google jobs in the U.S. in places like New York and Atlanta." Yes, he has dumped all the new positions from last year back into the trash. At the same time, $70 billion was spent on share buybacks, which primarily benefits large shareholders, as they are often long-term investors. For management, this increases EPS, making the company's performance look better and directly affecting their compensation and bonuses. These actions have nothing to do with cost-cutting through AI. About 5. Both teams have made significant contributions to Google. The transformer model that OpenAI relies on was built by the Brain team, and DeepMind is the famous inventor of AlphaGo. For a long time, the two teams have fought separately, treating Google as an academic research paradise. Today, they have finally found an opportunity to integrate and fight for Google's industry position in the next 20 years. This clearly expresses Google's anxiety in the AI business. According to the company's memo, DeepMind's former CEO Sabis will lead the new department, and Brain team leader Jeff Dean will become the chief scientist. To balance, both will report to Google CEO Pichai. The first product launched by this team is the Palm API. The iteration speed and usage scale of this API will serve as the basis for us to measure whether Google has the ability to compete with OpenAI. Thanks for watching our video. If you liked it, please subscribe to receive our analysis of other companies' earnings call firsthand.